Imagine working your entire life, 40 years of punching in, showing up, paying into the system. And then the moment you finally retire and start collecting Social Security, the government quietly reaches back in and takes a chunk of it. Not because you did anything wrong, not because you broke any rules, but because nobody warned you about a number, one invisible threshold. A line in the tax code that millions of Americans cross every single year without even realizing it. And once you cross it, up to 85% of your Social Security benefit becomes fully taxable income. This is not a scare tactic. This is not speculation. This is happening right now. And if you're collecting Social Security, or you're planning to collect it in the next few years, what you're about to hear could be the most important financial information you receive all year. If this is your first time on this channel, hit that subscribe button right now. Because what we cover here, the warnings mainstream financial media ignores, the traps that quietly destroy retirement plans, this is exactly what Retire Shield exists for. And share this video. Because the person sitting next to you, at the dinner table, your sibling, your neighbor, your closest friend, they probably have no idea this is happening either. Let's talk about what's actually going on. There's a concept buried inside the US tax code called the combined income formula. Most people have never heard of it. Most financial advisors gloss over it. And yet, this one formula is the reason why hundreds of thousands of retired Americans open their tax return every spring and feel like the floor just dropped out from under them. Here's how it works. The IRS doesn't just look at your Social Security benefit in isolation. Instead, they add together your adjusted gross income, that's your wages, your pension, your 400 RMD withdrawals, your investment income, and then they add half of your Social Security benefit on top of that. The number they get is called your combined income, and once that number crosses a certain threshold, your benefits stop being tax-free and start becoming taxable. For single filers, the first threshold sits at $25,000. For married couples filing jointly, it's $32,000. Cross those numbers and up to 50% of your benefit becomes taxable. But here's where it gets dangerous. Push past $34,000 as a single filer, or $44,000 as a married couple, and now up to 85% of every Social Security dollar you receive is subject to federal income tax. Read that again. 85% taxable, not because you're rich, not because you have some massive inheritance. In many cases, because you simply took a modest 401k withdrawal, or because your spouse still works part-time, or because you did everything the financial system told you to do, save in a traditional IRA, invest in taxable accounts, build income streams, and now those income streams are being counted against you. And this is where most people don't realize the trap is being set long before they retire. Picture a couple. Let's call them Robert and Sandra. They're both 68. They've been retired for 3 years. Robert collects an $800 a month in Social Security. Sandra collects $1,400. Together, they're bringing in $32 to $100 a month just from Social Security. That's $38,400 a year. On the surface, that sounds comfortable, reasonable. They saved well. They have a traditional IRA with $400,000 in it, and they're taking $2,000 a month in distributions to cover their expenses. Now, here's the math. Their combined income formula looks like this. $24,000 in IRA withdrawals, plus half of their $38,400 in Social Security, which is $19,200, gives them a combined income of $43,200. They're a married couple. They just crossed the 85% threshold by nearly $1,000. So what happens? More than $32,600 of their Social Security benefit is now taxable. Robert and Sandra, who thought they had a solid retirement plan, are suddenly paying federal income taxes on money they worked their entire lives to earn. They didn't see it coming. Their previous financial advisor never walked them through it, and by the time they realized what was happening, they'd already been doing it for 2 years. That's not a rare story. That is the story for millions of Americans right now. But here's the terrifying part. The thresholds haven't been updated since 1983, when Ronald Reagan was president, when the average Social Security benefit was a fraction of what it is today. These thresholds were never indexed to inflation. They were never adjusted for the modern cost of living. They were set, frozen in place, and left there, while inflation quietly pushed more and more middle-class retirees over the line. This wasn't an accident. This was how the government engineered a slow, invisible tax increase on Social Security recipients without ever having to vote for one. Every year that passes without an adjustment to those thresholds, more retirees get caught. And with Social Security, cost of living adjustments pushing benefits higher, which sounds like a good thing, those same adjustments are actually dragging more people into taxable territory. You get a raise on your benefit, and it costs you. That's the trap inside the trap. Now, you might be wondering, is there anything you can actually do about this? And the answer is yes. But the window is closing, and the moves that protect you have to be made before the income is recognized. not after, not at tax time, before. The single most powerful strategy available to most retirees right now is a Roth conversion. Here's the idea. If you have money sitting in a traditional IRA or a 401k, every dollar you withdraw from those accounts in retirement counts toward your combined income. But if you convert those funds to a Roth IRA and pay the taxes now during a lower income year, future withdrawals from that Roth account are completely tax-free, and they don't count toward your combined income calculation at all. That means you can pull $2,000, $3,000, even $5,000 a month from your Roth IRA in retirement, and not a single dollar of it increases the taxability of your Social Security. You've essentially created a tax-free income stream that sits outside the combined income formula entirely. For some retirees, a well-executed Roth conversion strategy can save tens of thousands of dollars over the course of a retirement. But this isn't a move you make carelessly. Converting too much in a single year spikes your taxable income and can actually push you into a higher bracket, triggering the very problem you're trying to avoid. This is a surgical move that has to be timed, planned, and executed with precision. There are other moves worth knowing. If you have a taxable brokerage account and you're sitting on long-term capital gains, be careful about when you realize those gains. Every dollar of recognized gain adds to your combined income. Holding those positions a little longer, or harvesting losses to offset gains, can keep you below the threshold and preserve the tax-free status of your benefit. Here's another one that surprises people. If you're still working part-time in retirement, and a lot of people are, because the cost of living demands it, that earned income is fully counted in your combined income calculation. Even a modest $12,000 or $15,000 a year from part-time work can be enough to push a single filer over the threshold, sometimes dramatically over it. And required minimum distributions, the mandatory withdrawals the IRS forces you to take from traditional IRAs starting at age 73. Those are a ticking clock for this exact problem. If you haven't started RMDs yet, every year you wait, your account grows, and the eventual mandatory withdrawal gets larger. For some people, those forced withdrawals will be enough on their own to push 85% of their Social Security into taxable territory, even if they don't need the money and never plan to take it. This is why planning before 73 matters so much. The years between retirement and RMD age, sometimes called the golden window, are often the best opportunity to do Roth conversions, manage income levels, and build the structure that will protect your benefit for decades to come. Except that's not even the full picture. Because at the state level, the tax situation gets even more complicated. The federal rules are one thing, but depending on where you live, your state may also tax your Social Security income, or it may not. Right now, there are states that fully exempt Social Security from state income taxes, and there are others that apply their own version of the combined income test. If you're planning a retirement move, or if you've already retired and are thinking about relocating, this is a factor that can mean thousands of dollars a year in savings, or thousands you didn't budget for. The cost of living in states with no income tax on Social Security can be dramatically different, and the math isn't always obvious. But for retirees in states that do tax benefits, the combination of federal and state taxation can mean you're losing nearly half your benefit to taxes. Half. On money you spent a lifetime earning. Drop a comment below and tell us, are you in a state that taxes Social Security? Have you already looked into this, or is this new information? Because I promise you, you are not alone in discovering this late. Let's talk about one more thing, and this one hits differently. Because it's not just about the math, it's about what the system represents. Social Security was sold to the American people as a safety net, a promise. You pay in, you get back. It was supposed to be retirement security, not a tax trap, not a calculation that punishes you for saving responsibly, not a system where the middle class pays a higher effective tax rate on their benefits than someone who saved nothing at all. And yet, here we are. The people who are getting hit hardest by the combined income formula are not the wealthy. The truly wealthy have tax attorneys and accountants who structure their income to avoid this entirely. No, the people getting hurt are teachers who saved in a 403b for 30 years, truck drivers who invested in an IRA because they didn't have a pension, nurses who put away a few $100s a month for decades because they believed in doing the right thing. These are the people sitting at kitchen tables this June, staring at tax bills they didn't see coming. And the system, the policy, the frozen thresholds, the unchanged formula, is not going to fix itself. Which means the only protection available is information and action, and making sure that people around you know what's coming before it hits them. This is exactly why this video needs to reach more people. If you've watched this far, you understand what's at stake. Not just for you, but for the people you love, your parents, your siblings, your friends who are heading into retirement thinking they have it figured out. Share this video with them right now, not later, now. Because the moves that protect Social Security income from taxation have to be made proactively. And for some people, the window to act is already starting to close. And if you want to go deeper, if you want to understand how to build a tax-efficient retirement income plan that protects your benefit, manages your combined income, and keeps more of your money in your pocket, hit the subscribe button and stay connected to this channel. Because this is what we do here at Retire Shield. We don't sugarcoat, we don't oversimplify. We give you the real information, the hidden risks, and the strategies that actually work. The system isn't going to warn you. The government isn't going to send you a letter. The only warning you're going to get is the one you're watching right now. Don't let it slip by.